Well, the Dow is higher today as the Federal Reserve kicks off a two-day policy meeting, and investors, well, they're anticipating more dovish action ahead. So how will the Fed's next move impact the market going forward? Joining me now, KPMG's chief economist, Constance Hunter, and Wall Street Journal global economics editor and Fox News contributor, Jon Hilsenrath. Jon, do you think the street could be getting in just a little bit over their skis, anticipating even tomorrow either hints at removal of quantitative tightening or some sort of action that would suggest it's going to be removed soon?
Well, I mean, I'm not sure where the street is right now, but I do think that the Fed is closing in and could be saying something about when they're going to end the runoff that they're doing on their balance sheet. But, you know, I think that the Fed is not going to answer the most important question, which hasn't gotten any attention on Wall Street, which is, you know, even when they stop shrinking their balance sheet, they have to reconfigure the way it looks. They have a lot of bonds in their portfolio. And there's a debate going on inside the Fed right now, which hasn't been resolved, about whether, you know, once they get to an ultimate size of $3 trillion or $3.5 trillion, do they want to have mostly bonds or do they want to have mostly bills? Do they want to have mostly long-term stuff or mostly short-term stuff?
Why does that matter, Jon?
Oh, it matters. It matters immensely, because when the Fed went out and bought all these bonds, the whole idea was that they were taking risky long-term securities out of the market and holding it at the central bank. And, you know, Bernanke thought this was so important, he didn't want to name the program QE. He wanted to name it long-term securities asset purchases. If they go to bills, then they're allowing all this risk to go back into the market, and it's just not as stimulative to the financial system or the economy if they hold bills instead of bonds. Right. That, I think, is the most important discussion they're having today and tomorrow, and I don't think that's going to get resolved right now.
Well, maybe because now there's a question and answer period. If it's not resolved, maybe we'll at least learn more about it. Yeah, Constance, your thoughts? How are you sort of handicapping tomorrow?
Yeah, so I just want to address the balance sheet issue, which is that, look, the Fed wants this to be neutral. They want it to be, they want to get the balance sheet to what they consider neutral. And they made an important discovery, which is that the demand for reserves is now higher than before the financial crisis. So they need to hold more reserves on their balance sheet because there's higher demand from banks. But they want it to be neutral. So when
there's a big gap between $900 billion and $4.5 trillion.
True, and that gap's going to be met probably at around $3 billion. Right.
So that means a lot more quantitative tightening.
No, they want it to be neutral. It means that there's a lot more demand from banks to hold those reserves, right? So this debate about, do they have it map the Treasury market, that is, be a mixture of short and longer term securities, or do they just keep it short term, is the objective and the criteria for that conversation is how can it be most neutral? So that's my view on what's happening with the balance sheet. With regard to the market and the Fed, the market is still expecting, if you look at the futures market, we're still looking at one more rate cut this year, whereas economists suggest the 75%, 75% of economists think there's going to be one more rate hike pushed into the dot plot, as opposed to 3, which is what we got in December.
And of course, you side with Wall Street, with the traders.
Well, it's a tricky thing, right? Because
I mean, I know you're an economist, but do you think that there will be more, if you had to go out on a limb and say one hike or one cut this year?
I'd go with nothing. I'd say if I had to go between those, I'd go with nothing. And it depends on how much momentum we have this year. They certainly have the room not to cut, right? We don't have inflation pressures. Now, they may come down the pike, but we have plenty of time to handle that, right? We don't have an economy that's having runaway growth, right? We certainly have a global situation that puts a lot of our growth at risk. Right. And so I think 0 before the end of the year is perfectly reasonable.
Jon, we had a chart up as you were speaking. It came from the Journal earlier this week. It was the balance sheet as a percentage of GDP. And it appears to have peaked in 2015. To Constance's point, does that give the Fed room to be neutral? In other words, not neutral necessarily, but to not do anything, to just sort of stand on the sidelines and let the economy evolve on its own?
Well, I think Constance makes a very strong point. I think there's a very high probability that the Fed does nothing this year. An extremely high probability they don't do anything in the first half of the year, because they have to see how a lot of things play out. It looks like we have a first quarter slowdown. They got to be well into the second quarter before they make any decisions by mid-year. And, they might just want, and as long as inflation is coming in soft, and it is, they might just decide to do nothing. I think the wild card for me this year is that there's a budget deal that has to get done by September 30th, or else federal spending goes back to 2011 levels. I think there's a lot of federal spending coming down the pike going into the 2020 election year. And that spending boost that I think Republicans and Democrats are going to agree jointly to do could change the mix for the Fed and lead it back into another tightening maybe later in the year or early next year. But we have to see into September if that plays out.
All right. In the meantime, maybe nothing like the movie Cool Hand Luke. Sometimes nothing's a real cool hand. Constance and Jon, thank you both very, very much.